Well, hey there, it's Terry Sawchuk from Sawchuk Wealth. It's Thursday, so that means it's time for 3-Minute Thursdays. And I wanted to talk about Jerome Powell's Fed press conference yesterday and the fact that they did not change interest rates, which was not surprising to anyone. The dot plot, which is essentially a forecast of where rates are going to be at the end of the year, shows that there is an expectation of 3 rate cuts between now and the end of the year, which really means sometime between now and September, because in an election year, the Fed typically isn't going to do much, if anything, actually with interest rates past September, because they don't want to be perceived as trying to influence the outcome. So between now and September, Jerome Powell had suggested that we're still on track for about 3 rate cuts this year. It's interesting because inflation has been creeping back up. In his commentary, he talked about the fact that they think that inflation was front-loaded to maybe more so that the first half of this year, and that as we get into the second half, they expected that to come down. He said that financial conditions were sufficiently restrictive. And what's really interesting about that is that when you look at measurements of financial conditions, they're actually really loose. So in spite of the fact that we raised rates as much as we did to get to right now, which is a 5.25% to 5.5% federal funds rate, the rise in interest rates really hasn't created tighter financial conditions, because behind the scenes, there's just been a massive amount of liquidity that's been injected into the financial system. And in so long as this policy remains more dovish, which is how I would describe it, it's probably going to be good for risk assets. And so the party rages on. We expect that the stock market will likely continue to push higher. One of the things that happens as the stock market goes up, because of the way that the hedging works and because of these structured products, we're now in a situation where as it goes up, it actually forces more buying. And it's counterintuitive, but it's just the nature of the way that these mechanical systems work. So until we get a major change in Fed policy or fiscal policy, and Janet Yellen's going to be speaking today, and I'm quite certain that her comments are going to be perceived as supportive for the markets, and very likely they're going to continue to issue debt, which is shorter in maturity, which tends to create more liquidity. And I think they're just going to do everything they can to keep the party rolling, at least through September, and we'll see what happens from there. So based on what we saw from the Fed, it looks like we're just going to keep pushing higher, and liquidity is going to be ample, and it's going to take some kind of exogenous event to really change the course of the market, at least in the short to intermediate term. So we're making adjustments accordingly, and we'll kind of keep watching the data as we need to, and we'll keep getting the research and try to focus on things that are going to make us money. So that's going to wrap up this week's edition of 3-Minute Thursday. I'll see you next week.